So we've all been aware that 2022 has been a pretty awful year for investing in the stock market. With a lot of people talking like we're going into a bear market, it certainly looks more and more possible as time moves on. And while it is still too early to tell if the remainder of the year is going to be as chaotic as the first few months, it's looking more like that could be likely, as now we've been experiencing the perfect storm of high inflation, high oil prices, among many other factors going on. But as I like to remind people, whenever the market falls, this actually creates a great opportunity to pick up more shares of stocks and funds at a much lower price. This will allow you to pick up some shares of a holding you may have been watching for a while, only at a much higher dividend yield now. So in today's video, I wanted to provide some suggestions on where investors can put their money in right now in order to collect some of the highest dividend-paying investments out there. Like I said, what we're currently experiencing may or may not get worse, but I think the following investments should be on the mind of every dividend and income investor out there looking for a good deal. Anytime the market falls, one of the best places dividend investors should consider investing in is Dividend Aristocrat stocks. These are stocks that have been able to increase their dividends every year for at least 25 consecutive years, and they typically offer very low dividend yields that make high-yield investors like myself less interested in them. But when share prices are falling across the board, this makes the yields for these kinds of stocks go up, and thus makes them more attractive to high-yield investors like myself. So under normal circumstances, people who are looking for high yields might not pay much attention to these kinds of stocks, but right now is actually the perfect time to look into these types of holdings. Let's take 3M as an example. About a year ago, this stock was yielding about 2.9%, which is pretty boring by most income investors' standards. 3M is a company that's been able to grow their dividend every year for 60 plus years, and they haven't missed a dividend payment in over 100 years. But given the current market conditions, along with what I'd consider to be minor litigation risks, their stock now yields 4.13%, which is almost as high as Realty Income, my favorite dividend stock of all time. But to be fair, Dividend Aristocrat stocks, even with a yield of 4%, aren't exactly that high yielding. So let's take a look at some other options out there. This next type of investment is one that I don't normally talk about too much on this channel because I know they aren't necessarily geared toward the general investor. They're a type of investment that's typically more attractive to people who are already retired, and the majority of them offer absolutely no growth in terms of dividends or share price. But despite these negatives, I think there's absolutely no denying that right now, there's a lot of good opportunities out there for people who are looking to invest in closed-end funds, or CEFs. Some of the most popular CEFs out there have gotten absolutely hammered this year, with many seeing their share price fall by upwards of over 20% to 30%. As a result, many of these investments are currently offering outrageously high dividend yields. It's not uncommon to see many of these funds offering dividend yields of 11, 12, or even 13% or more. In addition, many closed-end funds out there pay monthly dividends to shareholders. For one example, the Guggenheim Strategic Opportunities Fund, ticker symbol GOF, is currently yielding 12.55% according to Google. It also pays a monthly dividend of 18 cents per share, but over the long term, you can see that this fund hasn't increased their dividend since 2013, and overall the share price hasn't changed much since 2007. I see a lot of people confuse closed-end funds with ETFs because the two investments do have similarities to each other. Both CEFs and ETFs hold a basket of stocks, bonds, and sometimes other closed-end funds and ETFs, which makes them an investment that offers diversification. They're both traded on exchanges, so buying them is the exact same process, and they ideally trade around their NAV, or their net asset value. But there are some really important things that distinguish the two from each other. This is a useful chart by Hoya Capital that compares the two investments along with mutual funds. Some of the big differences between ETFs and CEFs is that there's always a fixed amount of shares of a closed-end fund, and they're almost always actively managed. Because of this, CEFs always charge higher expense ratios than ETFs. It's not uncommon to see a closed-end fund come with an expense ratio of over 1.5%. That's a lot more than the average expense ratio for an ETF, which is about 0.44% according to the Wall Street Journal. CEFs also use leverage. If you notice, there were periods of time when GOF had some pretty sizable drops in their share price throughout its history. The reason for that is leverage can make share price drops much more severe than the market. But GOF's share price has always recovered from these drops, at least up until this point. At its current price, a $10,000 investment into GOF would earn you roughly $104.52 every single month. That's a huge amount of income from just a $10,000 investment. If you wanted to earn $100 a month from a stock like Realty Income at its current price, it would cost about $27,500. But obviously Realty Income offers dividend and share price growth where GOF doesn't. Another popular closed-end fund that might be worth considering is the Pimco Corporate and Income Opportunity Fund, ticker symbol PTY. Again, no share price appreciation, and the monthly dividend has remained between 12 cents and 14 cents per month, but it still offers a massive dividend yield and a lower expense ratio than average for a closed-end fund. So all in all, if you happen to be in the market for discounted income holdings with monthly dividends, closed-end funds might be worth considering for you. But perhaps the largest dividends currently out there to shareholders come from covered call ETFs. These funds, which include QYLD, RYLD, and XYLD among others, buy a basket of stocks within a particular index and then write call options on the same index. Right now, all these three funds currently offer double-digit dividend yields, with RYLD currently yielding 14.24% according to Seeking Alpha. What's even better is that these funds offer investors monthly dividends, which is always better in my opinion. In general, these funds have taken a hit this year, with QYLD's share price falling the most at about 20% for the year. If you're concerned about the share price drop, there are a couple things I think people should keep in mind. Because of the massive monthly dividends these funds pay, all three of these main covered call ETFs by Global X are performing better than the market so far this year, and certainly all of them have been outperforming the specific index that the funds write call options on. Secondly, these funds have been able to keep their dividends at the same rate despite their share price falling this year. This has to do with how these covered call funds work. Since their inception, the monthly dividend amount has always fallen within a specific range for these ETFs. For example, if we look at the total dividend history for RYLD, we can see it's almost always paid between 18 and 25 cents per share since being launched. Because of this, these funds can make for good investments for people who want high income during bear markets. You can see last month RYLD paid a dividend of roughly 23 cents per share. If you invested $10,000 into RYLD at its current share price of $20.85 per share, and let's assume it pays a 23-cent dividend next month, that would equal to a monthly dividend of $110.73. But of course the dividend amount varies from month to month, so we don't know how much it's going to be next month. With that being said, if you're again looking for other high-yielding dividend holdings to take advantage of during this market turmoil, investing in covered call ETFs are another option you can consider in pursuing in your portfolio. One more thing I'd like to mention is that one of the best types of holdings you can have in your portfolio during periods of high inflation are REITs, or real estate investment trusts. According to the National Association of Real Estate Investment Trusts, REIT dividends have outpaced inflation as measured by the Consumer Price Index in all but 2 of the last 20 years. REITs provide natural protection against inflation because real estate rents and values tend to increase when prices do. This handy chart on their website compares how REITs perform during periods of moderate and what we're experiencing right now, high inflation. REITs typically perform exceptionally well, both when accounting for share price appreciation and the dividends paid to shareholders. If you happen to be a shareholder of some of the equity REITs I regularly talk about on this channel, you might have noticed that so far things have been performing quite a bit better for these REITs than the S&P 500 this year. With the S&P 500 currently being down over 17% for the year 2022 as of the making of this video, Realty Income stock is only down about 5.5% for the year. Another REIT that's doing really well is WP Carey, whose stock is actually slightly up for the year. And then we've got Iron Mountain, which is down about less than 1% for the year, and what I think is my riskiest REIT, Omega Healthcare, is only down about 5% for this year. And this is all before taking dividends into consideration. So with this in mind, if you're looking for a good hedge against inflation, we can see that time and time again, REITs are an excellent way of doing so. In the end, we can only hope that this volatility will slow down sometime soon, but hopefully this gave you some ideas on where you can put your money now so that you can collect some of the largest dividends out there. Just be sure to diversify your income portfolio across different sectors and investment types, and always perform your own research and due diligence so that you know exactly what you're investing in. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.